sleep on Friday thinking world peace just solved our global inflation crisis.
Right.
Only to wake up Saturday morning to Middle Eastern airstrikes and the U.S. government abruptly banning top-tier artificial intelligence.
Yeah, it was wild.
Welcome to Weekend Recap. I'm Daniel.
And I'm Muir.
And we are sitting down on Sunday evening to bring you this deep dive into the weekend's absolute whiplash of market news.
Mm-hmm.
Our mission here is to synthesize all the late-breaking headlines, recap the market action, and, establish a clear macroeconomic baseline. That way you can navigate the week ahead with actual confidence.
Yeah, rather than just reacting to the noise.
Exactly.
But just a quick reminder before we jump into the deep end. This deep dive is strictly for market context and discussion.
Right.
It is not personal investment advice or an investment recommendation.
Okay, so let's get right into session one.
Let's do it.
The big question we need to answer first is, how did markets price the macro tug-of-war this past week?
That's the million-dollar question.
Because, if you were looking at your trading screens on Wednesday, you probably felt that familiar pit in your stomach.
Oh, absolutely. The floor felt incredibly soft early in the week.
Yeah.
We started with some intense, systematic selling pressure.
Exactly. By midweek, we saw a serious slump. The S&P 500 hit a low of 7,266.99 on Wednesday.
Right.
And the VIX, which is, our favorite fear gauge tracking market volatility, it spiked all the way up to 22.22.
Which is high.
Yeah, when the VIX breaks 20, that's usually when portfolio managers start sweating.
Oh, yeah. They panic.
But then, almost out of nowhere, we saw this incredibly forceful, just violent late-week rally.
It was a huge reversal.
The S&P 500 clawed its way back, closing Friday at 7,431.46.
Wow.
And that aggressive buying basically compressed the VIX right back down to 17.68.
Yeah.
So, Mira, what actually drove that whiplash?
Well, you really have to look at the bond market for the answer. Okay.
That equity recovery didn't just happen because stocks suddenly looked cheap in a vacuum.
Right.
It was heavily supported by some massive relief in the rates and currency markets. We saw the 10-year Treasury yield, which, had been stubbornly high.
Yeah, it was choking off risk assets.
Exactly. It finally cooled off. It dropped from an early week peak of 4.552% down to 4.487%.
And when yields step back like that, it acts as this sort of pressure release valve for everything else.
Precisely. And when U.S. yields drop, it makes holding dollars slightly less attractive to global investors.
Which dragged the U.S. dollar index back down.
Yeah, down to 99.80. And, a weaker dollar provides massive breathing room for multinational earnings in emerging markets.
Yeah.
We actually narrowly avoided a scenario of carry trade unwinding as liquidity drain when those yields finally dropped.
Oh, yeah, that would have been messy. But the real fireworks, the absolute extreme downside volatility that caught everyone off guard was in commodities.
Yeah. WTI crude oil just completely fell out of bed.
It really did.
We're talking about crude closing on Monday at $91.30 a barrel and then plummeting to finish Friday down at $84.22.
That's a massive drop.
It is. And gold had its own wild ride, too. There was this huge midweek washout down to $4,108 an ounce before it recovered to close around $4,238.
Wait.
So we have plunging oil, recovering equities, and falling yields.
Yeah.
What is the actual macroeconomic backdrop driving this chaotic tape?
It really comes down to a fundamental tug-of-war between two very powerful opposing forces.
Okay, break that down for us.
Picture driving a car where you have one foot absolutely mashing the gas pedal and the other foot just slamming on the brake.
It sounds like a terrible way to drive.
It is. The gas pedal is a surprisingly resilient U.S. economy. The May jobs report was a total blowout.
Oh, the payrolls data?
Yeah, adding 172,000 payrolls and keeping the unemployment rate incredibly tight at 4.3%. So labor demand is a rock. People have jobs and they have money to spend.
But the brake pedal is sticky, persistent inflation.
Exactly. On the other side of the rope, the latest core PCE reading, which is, the Fed's preferred inflation gauge, is sitting elevated at 3.3%.
Which is not great.
No. And worse, the May Producer Price Index actually accelerated, up 1.1% month over month.
Wow.
Yeah, meaning businesses are paying more for wholesale goods, which they will inevitably pass on to those employed consumers.
Right.
This dynamic hot growth alongside hot inflation is exactly why the Federal Reserve is locked into this higher for longer stance, stubbornly keeping their target range at 3.50 to 3.75%.
Okay, I've got to jump in and unpack this right here.
Sure.
Because I have to push back a bit on how the equity market is behaving given that exact dynamic.
Okay, let's hear it.
If the Fed is genuinely stuck higher for longer because of that hot PPI print, we really have to talk about discount rates as financial gravity.
Right, the fundamental anchor.
Exactly. Let's anchor that concept for a second.
Yeah.
When the risk-free rate of return, like the 10-year Treasury yield, stays high, it mathematically reduces the present value of future corporate profits.
Yeah.
That gravity usually pulls equity multiples down hard.
Yeah.
Yet stocks are buoyant. Are we just looking at mega-cap CapEx as a market fragility mask?
That's a very good point.
I mean, we have this massive $700 billion AI capital expenditure supercycle happening right now. Is the sheer velocity of tech earnings from 5 massive companies just, temporarily outpacing the gravity of borrowing costs that are crushing the rest of the market?
You've just identified the exact fragility of the current baseline. The market's strength is an illusion of averages. It is concentrated heavily in these tech megacaps. Now, to be fair, their cash flows are very real. The data center infrastructure build-out is real. But because their valuations are priced for perfection, they require a flawless macroeconomic backdrop. If inflation proves to be a self-fulfilling spiral where higher wholesale costs lead to higher consumer prices, demanding even higher wages, that forces the Fed to actually hike rates again.
And then what?
If that happens, that financial gravity will reassert itself very quickly, and not even AI growth will be able to mask the broader market weakness.
Oof. Okay, so to wrap up session 1, what we saw was that by Friday's closing bell, the market had decisively ignored the inflation fears and priced in economic resilience.
Yeah, assuming a Goldilocks scenario where growth stays hot but everything else calms down.
All right, let's take a quick breather because when we come back, we need to talk about how the weekend entirely flipped that script.
Yes, stick around.
Okay, we're back. Let's get right into session 2.
So the critical question we need to frame this session around is, what weekend headlines just blew up Friday's pricing, and how does it shift the macro baseline?
Because, let's be honest, Friday afternoon feels like a lifetime ago.
It really does. If you were looking at your Watch Next items from the Friday, June 12th recap.
Yeah, investors were supposed to be spending this weekend calmly getting ready for Monday's routine data drops.
Right. We were expecting to focus on retail sales at 8:30 a.m. Eastern Time on Monday, the Empire State Manufacturing Survey, and industrial production data.
Just routine, run-of-the-mill economic updates.
Total noise compared to what actually happened.
Exactly. Instead, the weekend delivered massive geopolitical and regulatory shocks that completely stole the narrative and rendered those data points almost irrelevant.
Yeah.
Let's start with the Middle East. The entire reason oil sold off so violently on Friday, dropping 7%, was optimism surrounding a Pakistan-mediated U.S.-Iran draft peace agreement.
Right, and the proposed framework of that deal from Friday was historic. It aimed to fundamentally de-escalate the entire region. The draft proposed lifting the U.S. naval blockade, unfreezing up to $25 billion in Iranian assets, and most importantly, for global markets, immediately reopening the Strait of Hormuz to commercial shipping.
And that last point is massive.
Oh, it's huge. It represents a direct injection of supply and logistical relief into the global energy market. Traders looked at the draft, saw the diplomatic momentum, and basically priced it as a done deal ready for a Sunday signing ceremony.
And then came the Saturday twist.
Yep.
At exactly 7:23 a.m. Eastern Time on Saturday, June 13th, the Israeli military executed a highly precise airstrike on a Hezbollah command center in Beirut.
Unbelievable timing.
I know. That single calculated action completely stalled the Sunday signing ceremony and triggered immediate threats of severe retaliation from Iranian officials.
Yeah.
And the U.S. reaction was intense. President Trump was reportedly furious, famously calling Prime Minister Netanyahu and asking him, quote, "What the F are you doing?"
Well, it's very easy to look at an event like the Beirut strike as, an unpredictable natural disaster that just tragically derailed the peace process at the last minute.
Right. That's the gut reaction.
But if we analyze this through a game theoretic lens, it looks entirely different.
How so?
This is a textbook example of geopolitical brinkmanship as bargaining leverage.
Interesting.
Israel didn't act randomly. They acted to assert their own independent military leverage and establish hard red lines just hours before a major U.S.-Iran normalization deal was supposed to be inked. It's a calculated, deliberate move to ensure their specific security parameters aren't sidelined by the broader agreement. By proving they can blow the deal up at the 11th hour, they force all parties to factor their demands into the final text.
That makes perfect sense structurally.
Yeah.
Tactically, it leaves the oil market staring at massive implementation risk heading into Monday's open.
Oh, absolutely.
The 7% discount in crude was based on peace. If peace is stalled, oil could violently gap up. And while the geopolitical world was burning, we also had a massive shock in the tech sector over the weekend.
Yes, the AI space got completely derailed.
On Friday, June 12th, at 7:19 p.m. Eastern Time, well after the market close, and the weekend had officially started, the U.S. government issued an abrupt export control order targeting Anthropic.
Out of nowhere.
Literally. They forced the company to instantly halt all foreign access to its absolute elite AI models, specifically Fable 5 and Mythos 5, citing severe national security and jailbreak concerns.
The broader implications of this are staggering. It's not just an Anthropic problem.
Right.
We're already seeing tech rivals like Amazon raising concerns about the security of these models, and simultaneously, a coalition of state attorneys general is launching a sweeping probe into OpenAI.
It's a pile-on.
Exactly. What this action does is introduce a hard regulatory ceiling on what has, up until now, been viewed as AI capex as a cycle-agnostic arms race.
Let's define that for a second. The market has basically assumed that these massive tech companies are going to spend hundreds of billions on data centers, whether we are in a recession or not, simply out of fear of falling behind in the AI race.
Exactly. The foundational assumption holding up tech valuations was frictionless global deployment. You build the model in California, instantly monetize it across Europe, Asia, and the Middle East.
But Friday night's order shatters that assumption.
Completely.
This is exactly what I mean when I ask if the market is pricing ahead of physical reality by ignoring this.
Yeah.
The entire S&P 500 is essentially being held up by the massive profit margins of a few tech giants. If the U.S. government starts restricting foundational models and literally blocking foreign revenue streams over national security, those pristine profit margins could crack.
So to summarize where we stand right now, the baseline entering this new week is hyperfragile. You have an energy market that aggressively priced in a peace deal that is now stalled and teetering on escalation, and you have an equities market priced for frictionless, exponential AI growth that just slammed headfirst into a national security wall.
Wow. Okay, we're going to take one more short break. When we come back, we'll map out exactly what you need to watch in the week ahead.
Stay with us.
All right, welcome back. We are moving into session 3.
Let's do it.
The question we need to tackle now is, what are the critical events to watch in the coming week? Let's cut through the noise of the economic calendar and focus strictly on the June 14th watch next items.
Right. Looking at the schedule ahead, from Monday, June 15th to Wednesday, June 17th, all eyes globally will be on the G7 summit in Evian-les-Bains.
That's going to be a big one.
Yeah, you really need to watch for headlines regarding trade, tariffs, and geopolitical alignments. President Trump is signaling a very aggressive pivot toward new investment alliances.
Which means we could get some surprises.
Exactly. Those off-the-cuff headlines regarding tariffs will absolutely bleed directly into equities and the U.S. dollar in real time.
Okay, domestically. Monday, June 15th, brings us the U.S. Empire State Manufacturing Survey, Industrial Production, Capacity Utilization, and the NAHB Housing Market Index. Then Tuesday, June 16th, we get U.S. building permits, housing starts, and import prices. But let's be honest, looking at our baseline, Monday and Tuesday's housing and manufacturing data is mostly noise.
It is.
Everyone is waiting for Wednesday.
Yes, Wednesday, June 17th is the main event. We have the FOMC rate decision, their updated economic projections, and of course, Jerome Powell's press conference.
A big one.
Given the sticky inflation data we discussed in session 1, the Fed has to focus entirely on maintaining central bank credibility as an inflation anchor.
And if they lose the market's trust that they can actually control this 1.1% PPI spike, bond yields will just spiral out of control.
Exactly. Do not expect Powell to sound dovish or accommodating. He has to sound tough to keep long-term yields from breaking out.
Rounding out the week, Thursday, June 18th gives us U.S. initial jobless claims, the Philly Fed Manufacturing Index, and the EIA crude oil stocks.
And then Friday.
Right. Finally, keep in mind that on Friday, June 19th, U.S. cash equity and treasury markets are completely closed for the Juneteenth holiday.
Which changes everything about Thursday.
Yeah, which means Thursday afternoon is going to see a massive amount of chaotic portfolio positioning as traders refuse to hold risk over a long weekend.
Definitely.
And as our tradition to get your head right before the Monday bell rings, it's time for our dark weekend reset joke.
I'm ready.
As you pour that Sunday evening glass of wine, take a deep breath and appreciate that the VIX isn't spiking in the 20s anymore. Just remember that holding positions over the weekend is a lot like finalizing the current Middle East peace treaty. Right when you think the ink is dry, an unexpected headline blows the whole thing up. If your tech portfolio tanks on Monday, at least you can blame an unchecked AI model before the government bans it entirely. Rest up and enjoy the quiet tonight, because Jerome Powell is waiting for you on Wednesday, and he definitely doesn't care about your Sunday reset.
That perfectly captures the mood of this market. Now, let's transition to our bonus on-air session, the 2-minute paper trading segment.
Awesome. Let's check the scorecard.
For those of you tracking along at home, our public paper portfolio is currently sitting at $10,932.20.
Not bad.
That represents a 9.32% return, which is solidly beating the S&P 500's 4.29% return over the exact same period.
I will take that alpha all day.
Yeah. So, it's time to adjust our allocations based on this weekend's chaos. Walk us through your proposed trades for Monday's close.
All right, here is my thesis and my moves. I am selling $1,090 of the energy ETF, ticker XLE. That is a 10% position reduction. I am taking those exact proceeds and buying $545, so a 5% allocation of consumer discretionary, ticker XLY, and another $545 of technology, ticker XLK.
What's the justification there?
It's simple, and it leans into the macro dynamics we just discussed.
Yeah.
Despite the Beirut strike on Saturday, U.S. diplomatic pressure is immense right now.
Yeah.
The administration desperately wants this deal.
Yeah.
I believe they will force the Iran agreement through regardless of the brinkmanship, which firmly ends the oil shock. And we know from market history that an energy shock acts as a delayed consumer tax.
Right. When people pay more at the pump, they buy less stuff.
Exactly. If oil stays down, the consumer effectively gets a massive tax cut, which is incredibly bullish for consumer discretionary stocks in XLY. And I want to add to technology, XLK, because the AI cycle is fundamentally unstoppable. These export bans are speed bumps, but the domestic corporate demand is just too huge to fail.
I've got to aggressively counter that, because I think your explanation is far too neat given the very real physical risks on the board.
Okay, what are your moves?
I am proposing selling $1,000, which is 9.1% of our portfolio of utilities, ticker XLU. We have to respect the gravity of 4.5% Treasury yields.
Fair point.
Utilities are bond proxies. If investors can get 4.5% risk-free from the government, they are going to dump dividend-paying utilities.
That makes sense.
Crucially, though, I am doing the exact opposite of you on energy. I am buying $800 or a 7.3% addition of the energy ETF XLE.
Wow, okay.
You are entirely ignoring the physical reality of the stalled peace deal. The Beirut strike proves that geopolitical brinkmanship is still very much live, and that implementation risk means oil is currently underpriced.
I guess we'll see.
Finally, I'm buying $200 or 1.8% of industrials, ticker XLI. That lets us capture the physical AI infrastructure, the actual companies building the power grids, the cooling systems, the data centers.
Ah, the picks and shovel.
Exactly. We know that power access as the AI bottleneck is the real constraint, and XLI lets us play that demand without relying on the astronomical valuation multiples of the software giants in XLK.
Right. The beauty of this paper portfolio is that we aggregate and net our decisions to see what actually gets executed.
Let's hear the final numbers.
So, reading the final netted trades executing at Monday's close, we will sell the energy ETF, XLE, for $145, which nets out to a minor 1.3% reduction. We buy industrials, XLI, for $100, a 0.9% addition. We buy technology, XLK, for $272.50, adding 2.5%. We sell utilities, XLU, for $500, dropping our exposure by 4.6%. And we buy consumer discretionary, XLY, for $272.50, a 2.5% allocation.
And as always, a quick punchy disclaimer before we go. This is a live paper trading experiment and may fail at any time. It's for educational tracking only, and it is absolutely not financial advice.
As we wrap up this deep dive, I want to leave you with one final provocative thought to mull over before the markets open tomorrow.
Lay it on us.
If the U.S. government can instantly block global access to Anthropic's top models on a Friday night with a single bureaucratic directive, are we entering a new era where geopolitical national security dictates tech valuations far more than free market cash flows?
That is undoubtedly the defining question for the next market cycle, so let us know your thoughts and predictions in the comments below.